Insurance can be a real lifesaver if something unexpected happens. So, okay, we've talked about loans, leases, SBA programs, but you mentioned other options too, like credit unions, online lenders, even equipment manufacturers offering financing.
Right. There's a whole world of lenders out there, and choosing the right lender is almost as important as choosing the right financing type.
Okay, so let's dive into those a bit more, because it seems like there are some real hidden gems out there.
Yeah.
Let's start with credit unions. What are they all about?
So credit unions are financial institutions that are owned by their members.
Okay, so it's like they're owned by the people who bank there.
Exactly. And because they're not for profit, they can often offer better rates and terms than traditional banks.
Oh, that's interesting. So they're not just trying to make a profit for shareholders, they're trying to serve their members.
Right. And that can be a big advantage for small businesses. They're often more willing to work with businesses that might not have perfect credit or a long history.
So if you're a small business owner, checking out your local credit union seems like a no-brainer.
It's definitely worth considering. They're often very community focused and have a good understanding of the needs of local businesses.
Okay, what about online lenders? They seem to be popping up everywhere these days.
They are, and they can be a good option for businesses that need financing quickly. The entire application process is often online, and you can sometimes get approved in a matter of days.
Oh, wow, that's fast.
Yeah.
But I imagine there's a catch, right? What's the trade-off for that speed and convenience?
Well, online lenders often have higher interest rates compared to traditional banks or credit unions. They're taking on more risk by working with a wider range of borrowers, including those with less than perfect credit.
So you're essentially paying for that speed and ease of the process.
Exactly. But it's a trade-off to consider. And it's always smart to do your research and compare offers from multiple online lenders because interest rates and fees can vary a lot.
Okay, good advice. Now, tell me more about financing directly through the equipment manufacturer. This seems like a really intriguing option.
It can be a great option. Manufacturers often have deep expertise in their equipment's value, functionality, and how long it typically lasts.
So they know their stuff.
They do, and that knowledge can mean more accurate valuations and potentially better financing terms.
That makes sense. They're not just lending you money. They're invested in seeing their equipment used effectively.
Right. They often offer perks like extended warranties or flexible payment schedules that work with your business's cash flow. They might even bundle things like installation training and maintenance into the financing package, which can be a huge value add.
Wow, so it can be like a one-stop shop for all your equipment needs.
Exactly, and it can be a great way to build a relationship with the manufacturer.
Okay, but I'm guessing it's not always the cheapest option, right?
Not necessarily. While it can be super convenient and have great perks, it's still important to compare their terms with what banks or credit unions are offering to make sure you're getting the best deal for your specific situation.
So don't just assume that they're the most expensive or the cheapest option. Shop around and compare.
Exactly. That's always the best advice.
Okay, so we've got a lot of lender options to choose from. But with so many variables, how do you choose the right financing option for you? What are the key things to consider?
Well, first, you need to honestly assess your financial situation.
So how much can you comfortably repay each month?
Exactly. What's your current debt like? Do you have any upcoming expenses that could impact your cash flow? You've got to be realistic about what you can afford.
Right. And then there's the equipment itself. How long do you plan to use it? Is it something that might become outdated quickly? That's got to play a role too.
Absolutely. If you're in a fast-paced industry where technology changes, rapidly leasing might make more sense than buying.
Because you don't want to be stuck with a piece of equipment that's obsolete in a year or two.
Exactly. You've also got to factor in the total cost of ownership,
Yeah.
not just the sticker price or the monthly payment.
So think about ongoing maintenance, potential repairs, software updates. All those costs need to be part of your decision.
It's easy to get caught up in that shiny new equipment and forget about all the costs that come along with it. But those costs can really add up over time.
And speaking of hidden costs, don't forget about insurance.
Oh yeah, that's essential to protect your investment in case of damage, theft, or even a breakdown. And some financing agreements might require specific types of coverage, so read the fine print and know what's expected.
Okay, so we've assessed our finances. We've looked at the equipment's lifespan. We've factored in all the potential costs. Now, how do we actually apply for financing? That part can feel pretty intimidating, especially for newer businesses.
It can, but it doesn't have to be. The key is preparation. Lenders want to see that you've done your homework and are serious about your business.
Okay, so first and foremost, we need that rock-solid business plan we talked about earlier.
Exactly. That's your chance to really shine. It should clearly lay out your business goals, your target market, your revenue projections. It's basically your roadmap to success. And you're using it to convince the lender to come along for the ride.
And I bet your financial projections are super important too.
Absolutely. You're trying to demonstrate that this equipment will actually make your business more profitable, not just drain your bank account.
So lenders want to see that you've thought through the numbers and that this equipment is a strategic investment.
Precisely. They need to be confident that you're going to be able to repay the loan.
Okay. And financial statements are probably crucial too. Balance sheets, income statements, all that fun stuff.
Yep. Lenders want to see the hard numbers. They need a clear picture of your financial health.
And then there's the equipment itself. I'm guessing you need detailed specs and quotes from vendors.
You got it. Lenders will want to know exactly what you're financing, how much it costs, and whether you've shopped around for the best price.
So you're basically building a case for why this specific equipment is the right choice for your business and why it's a worthwhile investment for them.
Exactly. And don't forget, your credit score plays a big role here too. It'll impact whether you get approved and the interest rate you'll qualify for. The better your credit, the better your chances of securing favorable terms.
So good credit is key no matter what. It's like the foundation of the whole financing process. But even with good credit and a great business plan, there's still that approval process itself, which can feel like a bit of a black box. What actually happens behind the scenes once you submit your application?
It varies depending on the lender, but there are some common steps. First, they'll review your application to make sure it's complete and you've included all the necessary documents.
So this is where being organized and prepared really pays off. If your application is a mess, it's probably going straight to the bottom of the pile.
You got it. Then comes the credit check. Lenders will look at both your personal and business credit reports to see how you've managed debt in the past.
And this is where that good credit score we talked about really shines.
Absolutely. Next, they'll do a deep dive into your financials to evaluate whether you can handle the loan payments. They're looking at your revenue, expenses, cash flow. Basically, can you comfortably make those payments each month?
So even if you have a stellar credit score, if your financials are a mess, you could still get turned down.
That's right. Lenders want to see the whole picture. They'll also evaluate the equipment itself, its value, expected lifespan, and how it fits into your business operations. This helps them decide on the loan amount and terms they're comfortable offering.
It sounds like they're making sure the equipment is a good investment for them as well. They don't want to lend money on something that's going to break down or become obsolete right away.
Exactly. Everyone is trying to manage risk here. They'll also consider broader factors like your industry, business model, and the overall economy to assess the risk level of lending to you.
So even if everything else looks great, if you're in a volatile industry, you might face stricter terms or even a rejection.
That's true. Certain industries are just seen as riskier than others. After all that, there is the underwriting process where a specialist really digs into all the details to figure out your creditworthiness and the viability of the loan.
So this is where they scrutinize everything with a fine-tooth comb.
You got it. They're looking for red flags, inconsistencies, anything that might suggest you won't be able to repay the loan. Based on all of that, they'll recommend whether to approve or deny your application.
And if you're approved, they'll give you a loan offer outlining the loan amount, interest rate, repayment terms, or all the nitty-gritty details.
Exactly. And here's an important point. You can actually negotiate these terms. Don't be afraid to push back if something doesn't seem right or you think you can get a better deal elsewhere.
So it's not a take it or leave it situation.
Yeah.
There's some wiggle room, especially if you've got a good credit history and a solid business plan.
Absolutely. Once you've agreed on the terms, there's usually a final verification process where the lender double-checks everything and might ask for updated documents.
It's like they're making sure nothing major has changed since you first applied.
Exactly. Once that's done, you'll sign all the paperwork, close the loan, the funds will be released, and you can finally get that equipment you need.
Okay, so you've navigated the application, secured the financing. But the journey's not over, right? Managing your financing effectively is crucial.
You're absolutely right. First and foremost, you need a solid repayment strategy. You have to know exactly where the money for those monthly payments is coming from and make them on time every single time.
So this is where budgeting and cash flow management becomes super important.
Yeah.
You can't just wing it and hope for the best.
Exactly. Know how much money is coming in, how much is going out, and where those loan payments fit into the bigger picture. If cash flow is tight, you might need to adjust your spending or look for ways to increase revenue.
And then there are those unexpected expenses we talked about earlier, repairs, upgrades, those unexpected costs that can really throw a wrench in your budget.
It's a great point. It's essential to have some sort of contingency plan. Maybe it's a rainy day fund or a line of credit specifically for those equipment emergencies. You've got to be prepared.
Because those unexpected costs will happen. It's just a matter of when. Speaking of unexpected costs, let's talk about regular maintenance. It's often overlooked, but so important to keep your equipment running smoothly.
You're absolutely right. Regular maintenance can prevent expensive breakdowns later on. So
Yeah.
factor those costs into your budget, stick to the recommended maintenance schedule, and nip those minor issues in the bud before they become major problems.
And don't forget about insurance. That's a crucial part of protecting your investment, especially if you finance the equipment. Make sure you have the right coverage in case of damage, theft, or even a breakdown.
Absolutely. Insurance can be a real lifesaver if something unexpected happens. And some financing agreements will actually require specific types of coverage, so always read the fine print.
Okay, so you've managed your finances, kept up with maintenance, stayed insured. What happens at the end of the financing term? Do you just hand the equipment back and walk away?
Not always. It depends on the type of financing you have. With a lease, you might have the option to return the equipment, buy it outright, or even upgrade to a newer model.
So it's not a dead end. There's some flexibility there.
Exactly. And with a loan, you usually own the equipment outright once you've made all the payments, so
Yeah.
you can keep using it, sell it, or even use it as collateral for another loan if needed.
Good to know. I feel like we've covered a lot of ground here, but I'm curious about some specific scenarios. What about businesses that need to upgrade their equipment before the end of their financing term? Or those unexpected repairs that cost way more than you've budgeted for? Those situations have to be pretty common, right?
They definitely come up all the time. Let's start with upgrading equipment before the end of the financing term. That can be tricky because you're dealing with two sets of costs, the remaining payments on your existing financing A&D, the cost of the new equipment.
So what are your options in that situation? It sounds like a potential financial juggling act.
One option is to see if your lender has any upgrade programs. Some are flexible and will let you trade in your existing equipment and use its remaining value towards a new financing agreement.
So it's like rolling your existing financing into a new agreement for the upgraded equipment.
Exactly. It can streamline things and potentially save you some money. If that's not an option with your current lender, you might have to finance the new equipment separately.
Which could mean juggling two sets of payments. That's got to be tough on cash flow.
It can be. But there are things you can do to manage that, like looking for financing with lower monthly payments or negotiating a longer repayment term to spread out the cost.
And what about those unexpected repairs that just blow your budget? What are your options there?
If you have a good relationship with your lender, they might be willing to work with you. Some lenders offer options to defer payments or even restructure the loan to help you accommodate those costs.
So it never hurts to talk to your lender and explain the situation. They might be more flexible than you think.
Exactly. But if they're not willing to budge, you might have to consider other options like using your emergency fund, a credit card, or even a short-term loan to cover the repair costs.
And hopefully those repairs will extend the life of your equipment and make it worth the extra cost.
That's the hope. But sometimes those big repairs are a sign that it's time for a replacement. If the repair costs are getting close to the equipment's value, or if it's nearing the end of its useful life anyway, it might be more cost-effective to invest in something new.
Especially if that new equipment will be more efficient, more reliable, or offer features your old equipment doesn't have.
You got it. Sometimes those major repairs are a wake-up call that it's time to upgrade. If you're approaching the end of your financing term anyway, it could be the perfect time to bundle everything and get a new financing agreement for the upgraded equipment.
Okay, so we've covered upgrading equipment and dealing with unexpected repairs. There's one more scenario I'm curious about. What about businesses that just need to free up some cash flow, maybe to invest in other areas of their business or cover some unexpected expenses? Can you use your financed equipment to do that?
You absolutely can. There's a strategy called a sale leaseback that can be really helpful in that situation.
I've heard that term before, but I'm not totally clear on how it works. Can you break it down?
Sure. It's a two-step process. First, you sell your equipment to a leasing company. Then you lease the equipment back from them.
So you get a lump sum of cash from selling the equipment, and then you keep using it by leasing it back. That's a pretty interesting concept.
Exactly. It's a way to tap into the equity you've built up in your equipment without having to give it up completely. And it can be a great way to boost cash flow in a pinch.
But there have to be some downsides, right? Nothing's ever that easy.
You're right. The main downside is that you're committing to leasing the equipment for a set period, which could be several years. And those lease payments will probably be higher than your original loan payments since the leasing company is running a business and needs to make a profit.
So it's a trade-off. You get immediate cash flow, but it costs you more in the long run.
Exactly.
Mhm.
But for some businesses, that trade-off makes sense. It can give them the financial breathing room they need to invest in growth, cover those unexpected costs, or just ride out a tough period.
So it's another tool in the toolbox. It might not be right for everyone, but it's good to know about.